Well, there's a lot of things that we do the same as being a financial advisor in this business. There's everybody's trying to do the similar thing, grow wealth, provide the financial planning, all those things we do also. But I think the biggest difference is one, our core that we said before, faith, family, financing. We start with having to care about the client at the most highest level that we can, but also how we manage the money. We don't actually send it off to somebody else to put into a portfolio and manage it. A lot of advisors, what they'll do is they'll put a model together, put in 20, 40, as many as 40 different mutual funds in that model, spread it out over all kinds of different classes, and then act like they're doing something. And then as the market collapses, they say, hey, just hang in there, it'll be okay, it'll come back, and it will. There's two theories that I believe can make a client money. One is you buy and hold something today, and you hold on to it for the next 40 years. And for the most part, as the markets grow over time, you'll probably be all right. The problem with that is that what we've seen historically, all the research shows that in 2000 and 2008, when the markets collapsed, people didn't stay in their holdings. They left. They got scared. They lost 30, 40, 50, 60, as much as 85% in 2000 on the NASDAQ. So what they do, they leave. They sell their positions at the worst possible time. So what we've done over the years is done the research so that we can try to catch those big waves when we can. So for instance, for us, in an example in 2008, 2009, when the market collapsed, our clients were already part cash in treasuries back from 2007. So although the market screamed from 2003 all the way to 2007 and actually doubled during that time frame, we saw that all our data showed the market was starting to get pretty expensive. Well, what all that means is that if you stay put and you already bought when it's expensive or buying when it's expensive, guess what? It always has to turn around and go the other way until you get that valuation back to normal. All that means is the old saying, and it's been around forever, everybody knows it, but very few people do it. It's buy low, sell high. Most people buy high and try to sell higher. And what happens with that is that your emotions get a hold of you because you always want to buy something that's already either been winning or looks like it's been winning. In this industry, it's very easy for me to go back and say, hey, look what this investment did the last 3 years. It's up 20% each year. I can sell you that all day long and you feel good because you can see that the track record says that it's been up so much. But I would venture to tell you that that's actually one of the worst investments to buy because it's already done it. It's already made its move. We're trying to find value in the markets when it hasn't made its move. So as it increases and it stretches thinner and thinner, it's going to turn around, and the economy is going to turn around sooner or later. About every 10 years or so, something happens. So all we're trying to do is make sure that we get out of the way when it's already too expensive and get back in there and strong when the markets collapse. Because you want to buy low, sell high. It's such an easy thing to say, it's very hard to do, and obviously difficult, especially if you're not patient.